Hi. On this video, we'll be looking at ETFs. So I'm going to be talking about ETF and the ETF. In other words, we focus more on understanding what ETF is on a general basics. And then after that, I'll be having some other videos talking about different types of ETF, how you can invest in ETF, especially for in developing in stock market or stock exchange that are in developing countries. So this is going to be really helpful for people who are looking at opportunity to minimize their investment risk and optimize their return on investment. So the ETF is probably one of those type of investments that will help you to hedge against risk. But again, as I always say, this is not a complete financial advice, and I'm not licensed as a financial advisor, but this is going to give a general education, which I myself would explore. So work with me as I talk you through using AI to understand um, ETF, basically on general education basis. So this will be very helpful for people who have not invested in ETF in the past. So ETF basically stands for the exchange traded fund. That is the full meaning, um, more or less like stock, similar to stock. So an ETF is a basket of investments, just like we have portfolio, such as stocks, bonds, or commodities. It doesn't mean, I will explain this. So it doesn't mean that all ETF has stocks, bonds, or commodities included in that particular fund. So some ETF could just focus on S&P 500, for example, large companies solely. Some ETF could have a combination of multiple types of bond, like municipal bond, federal government bond, treasury bond, if you like, different countries bond. So they may just have portfolio of bond. While some ETF may focus on commodity like gold, uh, rare earth minerals, or other types of commodity. On the other hand, some ETF could have a combination of all of this. So it's quite a complex type of fund, if you like, but I will explain to you how the ETF works so that you understand what you are buying. Um, you can buy and sell ETF on stock exchange just the same way that you could buy just individual companies stocks. Instead of buying just those company stocks, you could when you buy ETF, you are buying a share from a company that has a combination of multiple financial instruments in their portfolio. So it's just like what we call the real estate conduits or the real estate investment portfolio, whereby you do not hold any property at all, but you are a real estate investors. So what you do is you provide capital. So there are companies that will specialize in buying properties, renting those properties out. It could be commercial, it could be residential, managing those properties for you. And what you do when you buy shares from those companies, when you say you are a real estate investor, you could buy maybe multiple shares by funding some of those investments. But the property itself, you can't really point at a particular property that you own yourself, that you are responsible for in terms of repairs, maintenance, looking for tenants. This company does all of that for you, but you hold a shares in that company that does that, and other people hold shares too. So the same thing applies in the case of ETF. It might look a little bit complex to explain, but as you continue to dig into the world of investment, especially in these days with AI streamlining the education process, you kind of get to understand how the ETF works. Now, let's look at an example of ETF. Suppose there is an ETF that tracks the S&P 500 index. When you buy one share of that ETF company, okay, so you indirectly hold a tiny portions of about 500 large US companies. So you hold it, but you hold it through an intermediate. So there's an intermediate, which is a company that manages those ETF, and um, it's the companies themselves that are part of that ETF, such as Apple, Microsoft, Amazon, and Coca-Cola might be combined, like those large companies, into a single ETF. So what you are buying, you're buying a share in the ETF, and all the ETF buys shares from different stocks and put them together as a portfolio that they manage on behalf of the investors. So you do not own a company directly. That's what I mean. But you own shares of the fund, which owns those companies. Now, how does the ETF works? Let's have a quick look at this following first steps. Before I go into this, I'll say why it is important that you watch this video and follow this video. You could do this yourself, but the whole point is uh, using AI to get this information, you have to get the prompt correctly in order to be able to have information very simple to understand in a plain text language without using technical jargons that is confusing, and also streamlining the information that the AI provide to you. If you just do this on your own, and you're not very good in streamlining the information that you need to receive from the AI, you're going to have a lot of information on your display that takes so much time to read and to understand. So, in other words, it's best sometimes to listen to experts who know how to use all of these tools to understand this. So now let's move on to look at how does the ETF work. So number one, a fund company creates an ETF. You know, in the past, when you go back to the history of stock trading, we used to have a company called the mutual fund companies or brokers. So these stock brokers, they are sometimes licensed to trade stocks, and they will have small office, physical office, and people will walk in and said, "I have this money. I want to invest this money into stocks. Would you advise me? Would you help me to purchase these stocks?" They help you with all of those process. They are intermediaries, but they themselves also have selected stocks in their portfolio. So they could have mutual fund they manage, and they will ask you to buy shares from their company to have a percentage of that. So I could say, okay, I set up a investment system, and if I use my fund to invest in the investment in any stock, 100% of the profit that I earn from the investment, I keep it. But some people might see that I'm so good with stock trading and they want me to trade for them. So what I could tell them is bring your fund. I will add it to my company. My company at the moment has about, say, for example, has about $2 million that is currently in my company that I use for trade. So when you bring your $2 million, you will have 50% of the companies that I establish, and I'll have 50%. When we have um, return on our investment by dividends or share price appreciation, you have 50% of that return, and I'll have 50%. That 50% we're talking about will be after minusing the expenses of running my company. That includes my salary as the fund manager, other people that I hire to work with me, analysts, desk help officers, tech people. So you basically hold some percentage in my company. But in terms of who holds those shares that I buy, will be my company's name that holds the share. You do not directly hold the stocks, but you have a stake in my company. Now let's move on to number two. The ETFs, the ETF buys the assets. It is designed to track stocks, bonds, etc., like commodity, as I mentioned earlier. Number three, the ETF issues shares to investors. So you buy shares from me, and I buy shares. You buy shares from my company, and my company buy the stocks, and my company holds the stocks. Sometimes we consider these as institutional investors that hold those stocks. But you who buy share from my company, you'll be considered as individual investor. Number four, investors buy and sell those ETF shares on the stock exchange throughout the trading day. So that's what I do full time. I look at I track the trading, I track the stocks movement, look at the Nasdaq, the Dow Jones, and others, and see how those stocks are changing. And I also listen to news and read newspaper and make sense of the situation and know what is going to change. Do I sell at this time? Do I buy? You buy at very low price, you sell at high price. Um, when there are some kind of what I call news media or news wordings. I read those news and I analyze the news, how that will impact stock prices, and then that will help me to make an informed decision. What will be my strategy in terms of buying and selling? What are the government policies when it comes to tax? What is the treasury talking about when it comes to interest rate? How would that impact some particular companies? Should I buy those companies now? What are the analysts' views about what the treasury decision will look like for interest rate raises or lowering the interest rate. So all of those things are things that I'll be doing full time um, in managing your fund for you, and that indirectly impacts how we get return on investment. So now number four, investors buy and sell those ETF shares on the stock exchange throughout the trading day. And we could buy this morning, we sell in the afternoon, and buy again in the evening and sell tomorrow morning. So basically, you have those kind of trade. Or we could buy and hold it for like 3 days, 4 days, or 1 week. So, and then we also kind of structure the portfolio on different type of stocks, short-term trade, long-term trade, and so on. So you have all of those returns. So why do people buy ETF? Interesting question. So why can't I just go on app and buy Microsoft stock and then hold that stock directly? Do I do that? Yes. Do I buy ETF as well? Yes. So people try to have a portfolio that is managed by some experts, and then they also take the risk of holding the stock directly. Sometimes people buy ETF because they just don't have the expertise to decide whether stock is going to be a good stock to buy or not. But if they have trust on some ETF, then they could buy those ETF. Again, it doesn't mean that the ETF guarantee a specific return. It all depends on the management of that ETF in terms of how effective and how reliable they are to be able to generate the expected return on investment. So people buy ETF for diversification purposes. As I said earlier, I could buy those commodity like gold, for example. I could buy them directly, and I could also buy stock directly by myself. And at the same time, I could also have some portion of it that is ETF. So that helps me to diversify my portfolio, not to be just individual stock, but a combination of different financial instruments. Lower risk is also one of those reasons why people buy ETF. As I said, a novice who have never traded stock before just jump into the stock market. Oh, I'm really sorry for that kind of individual because you're taking risk that you have no idea about. As someone who has studied um, accounting for several years and who have also taught different business courses, I still have to do a lot of education to be able to have effective trading. So you're just coming from different background without experience into the stock market, you might waste all your money eventually. So there are ways you can mitigate that risk, letting those who have the expertise to trade stock. When I started trading this stock, I didn't just start by putting significant amount of money into stock trading because I could potentially lose it. So I started with very little amount of money. If I could remember those days, whether I started with $5 or $10, thereabout, and my intention was to grow that $5 to become substantial amounts that I'll be using for stock trading. I wasn't looking at losing the $5. I was looking at having that $5 to grow. So how do I make it to grow? I buy at lower price and then I sell at higher price and I wait. When the price gets lower again, then I buy. So I kind of move them through different stocks. I get that kind of share price appreciation and at the same time also getting some dividend return and let that dividend compound into building my whole trading capital. So someone who has never done this before has no idea. Have I lost money? Yes. Have I made some money from the stock trade? Yes. So you have to understand these dynamics, and it comes with years of experience and education that sometimes you actually need to dedicate time to acquire. So if you don't have all of those things, doesn't really kick you out of the stock market. But you could also lower your risk by allowing those who have the expertise to do the trade for you. So lowering risk. If one company performs poorly, others may offset the loss. So with the ETF having multiple stocks in that portfolio, it helps to lower risk. So if you have Microsoft, you have Amazon, and then you may have non-tech companies. This is Microsoft, Amazon. These are tech companies or tech sector. You may have some health company like United Health, for example, and other type of healthcare companies in the portfolio. So if the stock for tech companies are going down for some reasons, that of health companies might be going up. Okay. Now imagine the time of COVID. If most of you pay attention to the stock market at that time, within I think the first few days when it was declared as a pandemic, you could see that the stock market decreased significantly. So you may have had all your investment wiped out. But for ETF, because they understand these dynamics, they would have already structured their fund to have part of it to be in the tech sector, part of it to be the health sector. Now, if the if the tech sector is going down and the health sector is going up, they kind of hedge against that risk. And one will perform against the other. And there are times both of them could be going up or could be coming down. But after time, depending on the event going on, you reduce your risk by diversifying and having multiple stocks in your portfolio would help will help to do that. So ETF does that much more better than having some individual stocks. And if you have those individual stocks, especially in one sector, might not be the best. But again, if you were investing in individual stocks, could you have also be able to diversify your portfolio in such a way that you could lower your risk? Yes, definitely you can. And I have done that as well. Now, lowering costs is also another part. Most ETFs charge very small annual management fees. Why some other stock platform or brokerage might actually charge you so much. Why the ETF? Because they manage large investments and they have fewer individuals working there. The management fees could be very low because they distribute that across the number of shareholders they have. So they kind of reduce your cost of managing your fund were quite more lower than what you could have. For example, if you are a medical professional, a physician, you may be better off going to attend to patients. You may be making much money from there doing that service and let people who will reduce your cost of managing your fund for you. If you put that time into researching stocks and trading stocks, you may realize that you're actually spending more money, even though you don't really pay cash for that. But the time you gave up not doing your physician job is an opportunity cost. So if you put that time, compare that cost to the cost of having ETF, you may realize that having ETF is much better than you doing it yourself. Now, easy trade is also another one. Buy or sell anytime the market opens. ETF does that. But the good thing I would also say about easy trade, there are some stocks that sometimes you don't have access to. Especially for some new IPO, they will be open to only institutional investors before it actually opens to individual investors. There are some private equity companies that you may not have access to those stocks. Some ETF might be able to buy stocks from those private equity. You could say there's a lot of potentials or benefit of having ETF. How do you make money? Yeah, let's look at that. That is the whole point. So there are two ways. One is price appreciation. The ETF itself, the price could appreciate. Remember, I mentioned earlier that you don't hold the individual stocks, but you have shareholding in the ETF. So now the ETF share price could appreciate over time. So you may have bought, for example, let's look at this. If the companies inside the ETF increases in value, the ETF price also rises. Okay, and that's because the collection of the financial instrument in that ETF has increased. And now, if you are buying any share from that ETF, has gone up too. Remember, you don't hold the individual stocks, but you have a share or stake in the ETF. So example is if you buy ETF at $100 and then you sell later at $120, then you have $20 profit due to ETF price appreciation, just like what you have on individual stocks. So dividends, if the companies in the ETF pay dividends, the ETF may distribute those dividends to investors or automatically reinvest the dividends depending on the ETF. And when you reinvest the dividend, you're actually having a compounding capital appreciation in your ETF, especially when the ETF does really well. In most cases, most investors typically want to reinvest their dividends. For example, I have automated setting for my investment whereby the dividend is not withdrawn from the account. The dividend is automatically reinvested in the same stock. But I could also make that a little bit different, take the dividends and look for other stocks and reinvest in other stocks to diversify. But often time, I don't have the time to go back and start looking at those dividends and try to work around them. But it also helps when it comes to tax perspective when you have automatic reinvestment in the same stocks. But again, that's a discussion for another day. Now, types of ETF. We have stock ETFs, which invest mainly on stocks. We have the bond ETFs, invest in government or corporate bonds, mostly government bonds in most cases. We have sector ETFs, focuses on one industry, technology, healthcare, and energy, and some ETF could have a combination of all of these. Commodity ETFs invest in gold, silver, oil, and similar assets. And then we have the international ETFs, invest in companies outside your home country. Okay, so they could have all this diversification strategy just to make sure they protect the investment and lower the risk. So ETF versus stock. Owning one company, owning many investment, high risk, low risk. Throughout diversification, you could see the difference here. High risk for individual stock, low risk for ETF. Again, investing in ETF, you have a portfolio of companies, and those companies more or less hedge against steady risk. Now, it depends on one business. When you have individual stocks, you rely on that company. So when we look at the SpaceX, for example, you buy SpaceX, we could say the SpaceX stock has decreased over time in the last few days. Um, But if SpaceX was part of it, an ETF, and you have other sectors too, like the oil, let's say a combination of both stocks and other commodity, you have the oil price that has gone up recently. So that oil price would have maintained the value of that ETF, even though the SpaceX is going down. And when you have that kind of situation, it's basically not depending on just one business, but multiple businesses. So can rise or fall dramatically when you invest in just individual stock. When you invest in ETF, usually less volatile. Again, goes back to the hedging strategy. Now, as we get to the last part, simple analogy. Imagine you want fruit. Okay. Buying Apple stock is like buying one apple. Buying an ETF is like buying a fruit basket combination of many fruits containing apples, oranges, bananas, grapes, and pears. So if one fruit is bad, the whole basket still has value because the other item of fruits in the basket can be sold for value. But if you just buy one apple and the apple is bad, then you lost all your value. So you could see why people may consider to buy ETF. In the next video, I'll be talking about different types of ETF and looking at some ETFs that might be a potential great ETF to buy.